Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Global stocks jumping to a record. That's after the latest U.S. inflation reading bolsters bets on a Fed rate cut next month.
President Trump to consider expanding the government's cut from China chip sales as Bloomberg reveals Beijing is urging local companies to avoid Nvidia's H20 processors.
Also ahead, Tencent in focus with earnings on deck as investors eye a path for shares to hit a record on the back of cheap valuations.
Plus, how a boom in Hong Kong's capital markets fueled by Chinese money is risking backlash from the U.S.
Good morning. Welcome to the show. The story remains the same. An equity market that is extending its rally. S&P futures, though, as you can see, are seeing a bit of a pause there. But that said, we are extending the gains on Wall Street. Nikkei again is up 43.2 now, and the Nikkei up 500 points. That's lifting the benchmark right now to about 6%. We're off 6% from the record high. This market specifically, 0.6% in Taiwan, flip the boards, please, is now at this level. I would say about half of 1%, if not even closer to an all-time high. We'll see what happens, of course, over the course of the session here. Right. Are we set up for a bout of dollar weakness again the next few months or so now that we're coming off the inflation print? Not really an ugly surprise there as far as the any nasty surprises that pivots the Fed's attention back to inflation as a part to the weak labor market. Yeah, we can talk about it later. 96% probability right now as I speak, and last I checked, that's the last thing I checked right before I came on set today, in terms of what swaps are pricing, probability of a rate cut next month. Very quickly, let's move into the approach to the Hong Kong Open. It's worth mentioning, too, that, again, this morning, intervention from the HKMA to defend the peg. And as far as A50 futures go, so we talked about Tencent earnings. We will get market reaction to earnings from Tencent Music. Moutai also came out yesterday. And we've been talking to Shanghai Composite. We're now within 1.3% of that 2021 peak. Yvonne.
Yeah, in terms of your agenda, you mentioned, of course, what happened with the HKMA, so watching honky dollar very closely. Yeah. There has been some talk about some more consumption sort of stimulus here, so China planning an interest subsidy for loans to boost consumption there as well. We talked about the Shanghai Comp rally, this kind of quiet one that Taiwan stock is talking about here today, really driven by liquidity, so we'll see how sustainable that is. But yeah, Tencent earnings are very front and center here today. Anything in terms of the AI plans and the like, of course, but we are still expecting those earnings to slow down there from a year ago. Rising CGB yields obviously is still the reflation story that we're watching very closely. In terms of stocks, it's chips, Tencent Music. That stock was moving overnight on the back of those earnings, and Moutai as well. Pretty weak earnings on that front there too, Dave.
Yeah, okay, let's talk about what this... Has anything changed from the U.S. inflation print overnight? And I think it's worth pointing out ahead of the Fed decision, I think September 18, 19 hour time, is you still have a few data points coming out, right? I think
yeah.
ISM, GDP, another PCE, another non-farm payrolls. But it does seem that there is a case there for, at least a strong case, market's now looking at a case to cut interest rates.
That seems to be what the market is kind of leading with here today after that CPI print. But it was interesting to see the return of services inflation. So it wasn't really tariff pass-through that you're seeing in goods. But you're still seeing lingering sorts of inflation pressures in the services side, airfares, healthcare, the like. Yeah. That may still be a headache for the Fed moving forward here. But certainly it's interesting, right? Bloomberg Economics' Anna Wong was saying that maybe we might still expect a hotter print in the core PCE data for July. And basically that means if you're betting on a September rate cut, maybe not so fast right now.
Not everything in one basket.
No,
there
don't
still
rule it
could
out.
be a minority case there, a minor case there to hold for September. What's interesting, though, is Scott Bessent floated the idea of not just 25, but he's floated
50.
50, right? We need to start talking about that. I mean, is that really how bad the economy is doing under this White House? Is the other, I guess, the naughty way to look at that. Okay, well, the data is telling us that there is not really a big problem with inflation. Maybe we can focus in on the
jobs,
weak labor market and, again, the case to cut interest rates. So what does it mean for equity markets? Helen is with us, managing partner and CIO at NF Trinity. Good morning.
Morning, guys.
So, done deal? Is it an assumption we can make right now that the Fed's going to cut interest rates?
We think that the rate cuts will start in September, right? Scott Bessent's point was actually that if they had seen the accurate NFP numbers for the last 2 months, the post 90% downward revision numbers, that there would have been Fed cuts earlier in the months already. Now, I don't think the Fed needs to necessarily rush forward with a 50 basis point cut right away, unless, of course, that beginning of September NFP comes in horribly. Then I think they might contemplate it. But if not, we think it's probably going to be 25 basis points. We actually think the inflation is not going to be as important of a constraint, even though it was a little bit hotter. We were talking about really, splitting hairs here. And also, I think within the core PCE, a very large component is the shelter or rent. And on that front, you're seeing bottom-up information coming through that as the supply is improving, actually the rents are moving towards neutral or even in some regions negative. So we think that over time, maybe in the next 6 to 9 months, that number will actually come down quite a bit and catch up with what's actually happening on a bottom-up perspective.
Do you think that we can, when it comes to tariff pass-through, can we put that aside now? I'm just wondering, or are we just still expecting some sort of pipeline of pass-through that's yet to hit? Or is it just going to be felt in profit margins, if I look at companies?
I think it's a combination of, where it's being absorbed, right? So some of it is actually being absorbed by the consumer, but a decent amount is being absorbed by the manufacturer. And then some, whoever is distributing it in the U.S., et cetera. And then some of it is being absorbed by the source from overseas. So there is definitely some impact in terms of the headline CPI, but the impact is not entirely reflected in the headline CPI. Moreover, numerous Fed officials have commented in the past that this is more of a one-off and nothing to really worry about on a sustainable basis. So I don't think that's going to have a really meaningful impact in terms of affecting their thoughts about the Fed funds rate path looking forward.
What does it mean for equity market or parts of the equity market that are sensitive to, the rate outlook or, PMI or cyclical sectors? What are you seeing there?
Cyclical sectors have been under a lot of pressure over the past couple of years, right? Actually, if you look at the ISM in the U.S., it's been in contractionary territory for a couple of years already. So whereas the U.S. consumer, U.S. AI, U.S. services, those have been very, very hot for longer than expected, everything in the traditional cyclical industries have been, quite constrained for quite some time. And for example, the overall housing market, the volumes have been dismal because of the fact that mortgage rates have been so high and therefore people have not necessarily been upgrading or buying. So I think those are the key things to watch for. If rates do come down, let's say 5 or 6 times by end of next year, as is forecast at the moment, which we agree with, then we think that those are probably incrementally the sectors that are going to benefit a lot more. So property, REITs, for example, which are, cap rates are going to be affected by the Fed funds rate or Treasury yields. And then, obviously, if the long end starts to come down as well, which is not entirely based on what happens at the short end, but if, employment numbers start to come off and various aspects of the economy show some mild signs of deceleration and soft landing, then we do think that actually, housing and property-related sectors will probably benefit versus others.
A dovish Fed, a weaker dollar, do you think that necessarily means stay in the U.S.? Right now, I mean, I think a lot of Fed managers out there still think the U.S. is still quite overvalued. Do you look elsewhere?
Isn't that a case for EM?
So the U.S. is basically at Goldilocks scenario from a fundamentals basis, as well as quite Goldilocks valuation, peak valuation across most sectors, except those few that are in the trough territory. We actually do think that outside of the U.S. has more compelling opportunities. We've seen massive amounts of foreign buying into the U.S. market over the last couple of years, mainly for the AI trade and the scarcity value of that, as well as the fact that the dollar was getting so much stronger and everywhere else's economies were actually not doing so well. But now I think that story has changed a little bit, right? The relative growth rates have evened out to some extent. We actually see that other economies are starting to stimulate more on the fiscal side versus before. Some of them have more structural reforms. And so in the recent months, we've seen that the foreign buying into the U.S. has gone from massively positive to actually more like neutral. It's not showing outflows just yet, but I do think that less inflows into the U.S. specifically means foreign investors are allocating in their home markets. And over time, even though I don't think this is immediate because U.S. investors tend to be very home focused, but over time, if the dollar continues to show weakness as the Fed rate cuts come through, then I do think U.S. investors will gradually start to diversify a little bit more as well.
All right. We'll have more with Helen Ju, Managing Partner and CIO at NF Trinity, coming up. Still ahead, we're going to check in on Chinese earnings ahead of Tencent reporting earnings as well. Kweichow Moutai delivering its slowest sales and profit growth in years on weak consumer demand and the government's austerity drive.
Yep, distilling that reality with a sub 9% growth handle there. But ahead of that, Beijing said to be urging local companies to avoid Nvidia's H20 chips, complicating its return to China. Analysis next from longtime Nvidia holder and bull, Ross Gerber, counting down to the open of trade here, about 20 minutes away. Shanghai, Shenzhen in Hong Kong. Just to also mention at the top, the next hour we have a briefing coming through on consumption, and perhaps this time tomorrow morning, again, here we are, a Typhoon Signal 3 is being mulled by the Hong Kong Observatory. The opening bell 19 minutes away. Right, welcome back to shows. We're about 70 minutes. Okay, I'm losing my math here. Into the cash market session. Topics index up 1%. The big news just dropping right now. We don't have a lot of details on this just yet. Japan is starting anti-dumping investigations into steel products from China and also from South Korea. So we know so far, nothing much to note. We'll get you more details once they do become more apparent.
Okay, that's one thing to watch here. Another thing we're watching, of course, is the chip space, with Bloomberg's been told that Beijing is urging local firms to avoid Nvidia's H20 processors, especially when it comes to government use. Now, that could limit President Trump's hopes of turning his export control reversal into a revenue windfall. However, Chinese companies still prefer Nvidia's chips for certain AI applications and may not be ready to switch to local alternatives. We'll see. Our next guest has been holding Nvidia since the stock was at $2. Joining us now is Ross Gerber, President and CEO of Gerber, Kawasaki Wealth and Investment Management. So obviously you're a longtime holder of the stock, Ross. I have to ask you then, does this news on Nvidia and what China has been urging, or at least stressing to its companies, does that change anything in your eyes?
Not really, and I guess you gave away I'm not that young either, because it's been a 15-year journey with Nvidia, and the issues with China are legitimate because the chip that they're selling in China is inferior to what the rest of the world and what America is buying, and it's substantially inferior. So there's a lot of risk of building a lot of systems around the chip when really it's not the best technology. So it's almost like ceding a lesser position in AI to your competitors. So I'm not sure how the chip will do, but it's better than not being able to sell it at all, which was the position we were in not too recently.
Yeah, I was going to ask you actually if one of the theoretical experiments a few weeks back was if Nvidia lost the Chinese market, does the bull case still hold up? I'll put that question to you, Ross.
Well, yes, it does, but no, in the sense of obviously China will be a formidable investor in AI as everybody is, and where their dollars will go and how their systems will be built and how compatible they are with other systems are going to be determined now by the foundations of the data centers that are going to be built. So quite frankly, from my perspective, you want the absolute best, top of the line AI chips. You want to do kind of what Elon's doing, and that's Nvidia, and there's no way around Nvidia at the moment. And so China's in kind of a pickle. So it's, do I buy the lesser chips and get going now, or do I try to get them Blackwell some other way? So this is a strategic advantage the United States has in technology, which is what we've always had, and why I've always been a technology investor in the United States.
Ross, Nvidia does report earnings on August 27th, about 2 weeks from now. What are you expecting this time around?
Well, it should be another good quarter if you look at Meta and all the other companies ramping up spending on data centers. We're kind of in this core stage. We've been looking at a lot of AI opportunities because that's what we see as an opportunity and also what clients want. And the truth is we're so early in this process that you don't want to get ahead of yourselves. We really have not even the power to build the compute necessary to really build the systems that people envision for the future, including robotics. So this is really a great position for Nvidia to be in, and certainly if there's more innovation from other chip makers, there's certainly lots of opportunities. We also are second positions in Broadcom in my fund GK, and so really it's a great time to be in the data center building business, and many of the sub players in that, including in energy.
Ross, certainly the concerns over the valuation are always almost a feature here when you talk about Nvidia the last few years or so. How useful is it to look at 1 year forward PE, or do we need to be looking beyond that and looking how that curve looks, just trying to understand what the, how long this runway really is?
Yeah, we tend to, being an investor in Nvidia for so long, it's traded around 40 to 45 PE for most of its existence. So, you don't get too many opportunities under that number. What I'm kind of amazed at is it still trades at that multiple when you have other stocks in a very frothy market trading at quite, a lot of stocks are trading at 100 times earnings, and they're growth stories, but the premiums now are extreme in the markets, and yet Nvidia, which is the best story in the market with the best CEO in the market, for some reason is still at, I'd say, a market multiple for big cap tech. So, it's hard not to like Nvidia. It's our biggest position, and it just keeps growing. And I'm loath to sell it, even though we're wildly overweight in certain client accounts, especially these early investors that did get in that early, because I'm a gamer, and that's the roots of Nvidia's business. And I was fortunate to be a gamer and figure out Nvidia 15 years ago, and then being in autonomy. So knowing what I know about autonomy and how that's growing so exponentially, and then cryptocurrencies, which is also GPU-based driven systems. So like almost everything is right for this company, and investors need to own it.
Ross, thank you so much. Ross Gerber, their president and CEO of Gerber Kawasaki Wealth and Investment Management out of the West Coast this afternoon. Their time there, of course. Still with us here on set is Helen Ju, managing partner, CIO at Trinity. Just your thoughts on that conversation we just had there.
Well, I think it's been a huge positive surprise for the entire AI ecosystem. In the first quarter results, people upped their capex for the full year this year. In the second quarter results, people upped their capex for even next year. So, this year, all the hyperscalers are spending something like 70 to 80 something billion per player per year. By next year, they're all going to be spending 100. So, we're looking at like 30–40% upward revisions just in the last 3 to 4 months alone, which is a huge amount of demand uplift. And that obviously really helps to lift sentiment on the entire ecosystem, NVIDIA being the key player within that ecosystem. But that said, as Ross mentioned, it's unclear, it's not 100% sure that all of this stuff can get executed and delivered, because there are certainly other constraints as well, like power and other components, networking equipment, and so on and so forth. So I think that's the thing that we have to watch out for. And the market's now thinking, well, if the expectation is now been marked up yet again to this level, when the second derivative of expectation is very positive, then stocks perform really well. But when that second derivative becomes flat, like no more upward revisions, or eventually people start to fear any downward revisions, looks like it's not going to be because of GPU demand problems, but maybe downward revisions because of, geopolitical issues, regulatory issues, or supply side issues in other parts of the value chain, then that's where I think the risk for that ecosystem comes in. But for the time being, people don't see that supply side constraint coming in imminently, maybe not until next year. So it's kind of, everybody's very positive on this entire space.
So do you stick to the AI winners because they've been doing quite well, or do you kind of look at something that's not as obvious now?
I think the key opportunities now, we definitely very much believe in the AI theme, and we think the momentum is still very strong, at least for the next 6 to 12 months. All the data that you're seeing from the large language models from a bottom-up perspective are exceeding expectations as well, even on a monthly basis, which is very, very impressive. So we do think that the momentum is there. That said, the key names have done extremely well and are relatively crowded and are not at low valuations versus history. So the way that we look at it would be 2 opportunity sets. One would be non-US major players like the second wave, or some of the Asian players that are doing the same thing as the US players but trading at discounts because there's some hair, right? People are worried about tariffs, or people are worried about the FX, or some European players doing the exact same thing as their US counterparts but trading at lower valuations as well. There's some catch-up room there. The second category, which is an even bigger opportunity, would be if there are any AI losers or AI neutral companies that suddenly move into that AI winner category, then they can see drastic re-rating in their valuation multiples relatively quickly. But that's going to be, hard to come by. So probably there's more companies that accidentally fall into the AI losers category from neutral and get derated a lot. That's actually the bigger risk in the near term.
Yet no one's paying attention to that.
Yeah.
Okay, I think we'll We'll turn the spotlight on that at some point. Maybe next year. We don't have to worry about it, as Helen was just pointing out. We'll talk about it next year. But Helen Judah will be staying with us for some final thoughts in the next couple of minutes or so. Right, just looking at the approach to the open today, and wow, we're actually looking at a sizable move in some of the big names. Alibaba's up 3%, Tencent is up 1.5%, JD.com 2.5%. So we are looking at a rally, 200 points currently on Hang Seng Index. Plenty more ahead. This is Bloomberg. Right, welcome back. 25,200 on the Hang Seng Index. We're up 200 points. We had a look at the fix of the day, 713.50. We're looking at earnings, reaction today. Tencent Music, I think Moutai will be coming out at the open. And of course, Tencent, the approach to that, we're up about 1.5% on shares of Tencent going into the session today. Baba's up 3%, and Bilibili, as you can see, is also up about 2% there.
Yeah, it's interesting. This is despite the fact that what we've been hearing, right, that Beijing has been in some ways pressuring some of these tech companies over their orders of Nvidia H20 chips as well. So it looks like investors are looking at something else here this morning. But certainly the earnings picture is certainly one thing to watch, though HS Tech did fall quite a bit yesterday. Leading up to some of these results. But Tencent Music, there you go. It's up 13% after those earnings, basically top estimates as well. Tencent is coming up next as well. We're watching Kweichow Moutai, of course. That was a pretty weak print from there. In terms of some of the chip makers, it was that Nvidia story and what Beijing has asked some of these companies that did lead to quite a bit of a rally in some of these stocks as well, like SMIC, Huahong. Maybe it might benefit some of these local chip makers if, in fact, the government is urging some of these companies not to do business with Nvidia in China. So that's the sort of the logic behind that. We'll watch some of the local A-share names coming up as well. In terms of analyst actions, there's a lot when it comes to Tencent Music, right? So here's just a list of what we've been hearing so far. But really, the likes of the ADR has been raised at Citi, from Daiwa, as well for the H shares. But certainly, there's been a lot of upside here, and certainly, maybe it bodes well for what happens with Tencent later on. But of course, two different companies. So.
Yeah. It seems like we are going into the open today with some momentum. Just to look at other markets as well, we are doing well across the region today. And the weather's quite hot now. We'll talk more about this in a moment as well, because of potentially a T3 typhoon signal this time tomorrow. More on that in a moment, including the open. This is the China Show. Right, welcome back. Extremely hot and humid session out there, so you don't need to buy and reserve your ticket for Burning Man this year. All you have to do is step outside. There we go. That's the free one for you. 200 points on the upside, though, on the Hang Seng Index. A50 future, 32 points. It's quiet on the data deck today in the Asia Pacific, with the exception. So we're done with South Korean employment, I believe, and we're coming up into a rate decision out of Thailand, where the one's actually quite close. Well, we can get to that later, out of the Bank of Thailand.
Yeah, so certainly one to watch here, the Bank of Thailand, and what we're watching the rest of these markets is really kind of this slow rally that's really churning in mainland China, right? And what Peter Alexander yesterday told us, there is this big sentiment shift here to really lean towards more risk, especially when it comes to those southbound flows, and really the liquidity situation is what really has kept this $11 trillion stock market staging this sort of steady resurgence, as our taking stock team and our stocks teams have called it. You take a look at what the onshore markets are doing. We're continuing to see upside when it comes to CSI 300. We're up about a fifth of 1%. Right now, we're watching very closely, of course, what happens in the tech space, because it really has been a good day when it comes to HS Tech. But CATL A shares are doing pretty well. Kweichow Moutai, that's the big earnings disappointment there, as we were talking about. Weak consumption, and certainly the government's campaign against austerity has really kind of hurt the liquor makers. So there you go. The shares are down 0.6% onshore here this morning, and that's bringing down the likes of a little bit Wuliangye as well. Flip the boards, we're watching very closely Hong Kong. So yeah, we're getting closer to Tencent reporting results later on here today. So we're still expecting, I guess you could say, more normalized growth when it comes to Tencent there. Yeah, obviously 2024 was a really robust year for them, so maybe there is a higher base here, but certainly a lot of talk about what they're going to do in terms of their AI plans, the capacity and the like. like here? And what does this mean with the fact that Nvidia can actually ship those H20 chips to China now? Are they willing to actually raise their capex? That certainly is going to be a big thing as well. But Tencent shares are up 1.6% leading up to those results as well. And really, it's the tech sector that's really bringing things higher. 3-4% gains for Alibaba here. And we're watching the chip space, right? So China urging firms to shun Nvidia H20 chips, given the security concerns here amidst this kind of Trump pivot. That has been helping some of these local chip makers here, the like SMIC Huaheng are up another 1% or so. Capricorn Technologies, that's actually heading lower. No surprise there, though. It surged by the daily limit of 20% yesterday on the back of that Bloomberg scoop. So certainly that's one thing to watch. Tencent Music has been doing very well. ADRs climbed from 4% after results hit top estimates as well. And so, Citi was basically saying revenue adjusted net profit were better than she expected as well. So certainly that's one thing to watch. And we have a bunch of analyst estimates there, analyst actions in terms of upgrading the stock this morning. And China Lit, that one's up some 6% here right now. So quite sizable moves when it comes to China Lit there. Revenue was a slight, see a bit of a slowdown there from a year ago, but certainly the stock is moving quite sizably up. Dave, but you've been looking at Tencent in particular, the stock price. I mean, obviously, we've been talking about this rally for China Tech, but what in particular you focus on today?
Yeah, our team have put out actually this almost full preview of what it might take for the share price to actually get back to the all-time highs, which as things stand, about 20-25% away. That's the blue one you see on your screens. Now, earnings estimates in yellow, as you can see, have been bumped up year after year to a record high. So the earnings story remains robust. And we put the two things together for you. That's just effectively PE, right? And PE on the chart takes you back to 2010, including your sort of sigma levels. And as things stand, trading at about 17 times earnings are actually still. Can we change the chart, please? This one here. Click. Thank you so much. There we go. There we are. 17.6 is still 1 sigma below the norm as far as Tencent goes. Now, how does this compare then to Tencent and its global peers? Click. Thank you so much. There we go. Sony, Nintendo, game makers, Meta Platforms, a bigger platform company, and also Apple. Tencent is in white. We should at 17 multiple in the earlier chart. That's basically in white below. And as you can see there, it does show that it is trading at a discount to, at least compared to its peers, Yvonne.
Yeah, for more on this, our very own Jeannie has been writing exactly about this very point. Jeannie, just tell us a bit more about what's expected out of the earnings from Tencent today.
Yes, I think basically when we talk to investors, there is a sense of optimism, when we enter into the earnings print. I think one of the major things they're looking at is like how those AI investment could potentially help boost their revenue from the, for example, the video accounts advertising revenue. That's one thing. I think the second thing people are looking at is how the gaming pipeline looks like, because we know they have a flagship game to be launched next week, which is a shooting game called Valorant Mobile. Currently, the PC version contributes a meaningful portion to their gaming revenue at the moment. So there is a very high expectation on how the Valorant Mobile version is going to boost the Tencent's gaming revenue for the rest of the year. And also, I think given that Chinese government, they have actually accelerated approving the gaming license so far this year. So people are actually keen to hear the Tencent's updates on their game pipeline in the next 6 to 9 months. So in general, I think people are expecting like 11% of revenue growth, which would be the third straight quarter for Tencent to report double-digit growth in sales growth. So I think which is really promising to investors when we talk to them. That's why many of them are expecting it should be no surprise for the share price to see historical levels again.
Yeah, it seems from one of the comments here in your piece, Jeannie, it's a question of when, if not, and not if, on the share price reaching that record high. What about other parts of the business? So outside of gaming, things like ad revenue, for example, what's the expectation there?
For the ad spending, I think people. So first, people would not expect for example, those food delivery giants. price wars to repeat in Tencent's business, and then with the economic growth slightly showing improving size, so they're expecting Tencent's ads revenue is actually kind of gonna benefit. But having said that, because some of the revenue contribution for Tencent's ad spend actually coming from the CapEx spending from companies such as Baba, such as Meituan. So if those companies that spend a lot, focusing on the investment in the food delivery sector, that means the investment in the ad spending for platforms like Tencent could be less. So that is one of the things when we talk to analysts, like they're a little bit concerned about.
Okay, Jeannie, thank you so much. Jeannie, you there with a preview off Tencent. The other stock we're tracking very closely, Moutai, is down in the early minutes here of trading today. Out with earnings yesterday, worst 6-month growth since at least 2016, as the company battling a couple of changing trends. You have this austerity measures as well that it's having clouding its outlook. Ada Lee, our Bloomberg Intelligence senior analyst, is here with us to talk us through, excuse me, let's start with the crackdown on austerity. And how is it different this time around from previous bouts of this, and how does it affect the business?
Definitely. So the latest anti-extravagant measures definitely hit China's sin good sales, and that's across tobacco, alcoholic drinks, and so forth. And we have seen it in the wholesale selling prices. And what we have also seen is very interesting anecdotal examples, such as at the latest Kweichow Moutai AGM. Instead of serving the flagship product, Feitian Moutai, at the banquet table, in line with the government measures, they have served blueberry juice. So they are definitely following the guidelines from the government to a T. And that is impacting the demand from the corporate side as well as, of course, from the government side. Versus 2012, where there was a massive crackdown on austerity and as well as anti-corruption practices, we actually believe this time could be a little bit milder and shorter in duration. And that is because, firstly, the demand from the government side has already reduced significantly since 2012 for premium liquor. Secondly, the liquor companies have also changed from more a corporate focus to more retail, individual consumer focus. So they've changed the channel as well. So consumer and channel mix could actually help them to weather the storm in this year.
What do you think is the outlook then for the remainder of 2025? There's a lot of talk whether they can hit their full-year targets. Do you think Kweichow can?
So for 2025, we still believe that they are within reach for the 9% revenue growth target that the management have set out. But remember, this 9% is significantly lower than the previous years of mid-teens percentage growth. Yet we believe that anything beyond that, so any upside beyond that 9%, is appearing less and less probable.
Yeah.
And that is because if you look at the austerity measure, it's definitely going to hit the near term, and we believe this could extend till year end. Secondly, consumer demand remains sluggish because of the economic environment. And then thirdly, what we are seeing is high in-channel inventory of baijiu across the industry. What this means is the companies already sold these packaged goods to the distributors, but the distributors are struggling to on-sell them to the end consumer because of sluggish demand. So what we're seeing now since the beginning of this year is a massive destocking across the industry for all baijiu brands, and that could continue to impact on demand.
Okay. We'll see how much blueberry juice is still out there.
I'm actually allergic to blueberry.
Are you?
Yeah, that's just a
that
random
wouldn't be
fact
good.
here. So
that wouldn't be good for you then.
In case someone wanted to.
You stick to Moutai.
Yes, yeah. Fortunately. There we go. Or fortunately.
Right. Ada Lee, thank you. Our Bloomberg Intelligence senior analyst now. Joining us for some final thoughts is Helen Ju, managing partner and CIO at NF Trinity. It's been a good Chinese equity rally for the first half. A lot of it is liquidity driven, but do you think earnings can actually kick this rally higher?
Look, I think a lot of it has been valuation shift, right? So in the domestic market, the national team has been supporting the SOEs and high dividend yielding stocks. And as the 10-year dropped to one handle, people started to look at like dividend yielding stocks as opposed to putting it into bank deposit.
Yeah.
And so I think that actually helped to overall re-rate a large portion of the index constituents. Earnings-wise, we don't have very high expectations, to be honest. I think that if we were looking at the second quarter of the year, certainly there's a lot of concerns about what's going to happen with the trade war. Property prices weren't really performing very well, so the wealth effect is not necessarily there either. So, you know, what we were talking about earlier with Moutai and the government consumption maybe having bottomed, but everybody else is not feeling that good about, you know, their broader net worth and therefore probably likely to consume a little bit less as well. So consumption numbers, we don't expect them to look too good. In fact, one or two companies that have already come out kind of guided down, or even some of them cut their dividends. So I think it's just kind of lukewarm. The one area where there could be some positive signs, not in the results in the second quarter, but rather in the forward guidance, is some of the cyclical sectors that are massively over capacity, because, you know, the government has launched this new round of supply side reform called anti-involution. You know, do not compete too much domestically when there is so much overcapacity. Try not to cut prices to the bone, etc. So from that perspective, there is higher expectations regarding steel, aluminum, solar, a lot of these sectors that were like deep in losses and below the cost curve. Maybe looking forward, there might be a little bit of a recovery off a very, very low base. So that's the kind of positive surprise guidance that we're hoping to hear from the interim results season out of China.
Other potential catalysts apart from, you know, what's obvious? You know, we had guests earlier on this week have told us about valuation and liquidity. That's going to be enough for this market to outperform.
If you look at the financials, you look at the telcos, you look at all the other SOEs, right? They've done very, very well already. So I think the laggards are basically cyclicals, but that requires policy support.
And
because,
inflation.
Which is definitely still missing, given all the massive overcapacity that was there previously, plus all the tariffs that are going to cut off a portion of the demand. So I think what we're missing is this consumption boost. If there's really some very meaningful policies that can really lift consumption and sentiment, I think that would be the one lagging area that shows up in consumer stocks, but also in internet stocks to some extent. But right now, a lot of the internet stocks are just kind of barely growing or growing a little bit, and therefore the valuations are nearer to historical, not trough, but like mid-cycle, right? In order for them to re-rate, you need to see a meaningful pickup in consumer confidence, probably led by stabilization or even a small pickup in property prices. That would be the leading indicator that we would be searching for.
Any upside on trade and tariffs and the resolution in whatever form that's going to come in, for example, between the two?
I mean, there's two components on the trade-related discussions with the U.S. One is the tariff itself, right? There, maybe the upside surprise would be the 25% that Trump imposed for the fentanyl. If China can make a better deal with Trump overall, then maybe there's some justification to say, oh, you know, they're making progress on fentanyl, therefore we will take away this 25%. But I think more importantly, the focus is going to be on more strategic issues, right? So semiconductors, for example, China really, really has a shortage of GPU. And therefore, I actually think that this concern about the import of H20 is more about specific military and other sensitive applications and customers, not the market as a whole. So if actually the trade negotiations cut off H20 altogether, that would actually be worse versus tariffs staying in place in some of the sectors, right? Because there will be adjustments, exemptions, and so on. So I think the strategic issues I'm actually watching much more closely.
Helen, thank you so much. For
Thanks,
spending the hour with us there. Helen Ju there, Managing Partner and CIO at Trinity. Just to also mention, the Shanghai Composite is an index we've been tracking, to Helen's point there, right? Very heavily weighted with the banking stocks and the dividend play. Has been enough to lift the benchmark now to the highest since 2021. It literally just happened the last few seconds or so. So there we go. Let's call it 3,700. Okay, let's round up, shall we? Plenty more ahead. This is Bloomberg.
All right, we're talking about China Evergrande Group now, saying that its Hong Kong stock will be delisted more than a year and a half since trading was suspended. Now, liquidators are also warning that its debt load is much greater than previously feared, and it marks the end of an era for the former high-flying developer whose demise has come to symbolize the country's property bust. Let's bring in our China credit reporter, Trista Luo, on what this delisting means.
Yeah, I think it's a symbolic moment for the China's property sector, right? In some way, the fate of Evergrande actually represents the ups and downs of the whole sector. And right now, the delisting case is actually means, the golden era of this whole sector has officially gone. I think right now, liquidator is working around a lot of things, and it's first time they pointed out that the company could face far more debt load than previously we knew, like up to $45 billion. So previously we only knew that it will be about $27.5 billion. So it's far more than what we knew previously. But, it's seems a year, more than a year since they were appointed as liquidators. So they actually grabbed something on the asset sales, and also they take control of a lot of subsidiary. But we need to know that it's a really large and complicated liquidation, so we're still at a very early stage of it.
What's next in that sort of, it's a parallel but separate process, right? Liquidation.
Yeah.
And can shareholders have any, now it's delisted, do they have any hope of collecting anything?
Well, at right now, this moment, no. But I think liquidators are working a lot on. There are a lot of litigation, a lot of trials ongoing. We are expecting the trial against its founder, Hui Kai-yan, will return back to court in September. And it's a very crucial trial for the liquidator and for the whole creditors, because its founder, Hui Kai-yan, is actually holding 60% of the company before it collapsed. And still right now, and also it has pockets more than $7 billion over the past decades due to the company's generals paid out. So there are lots of things going on, lots of factors moving, but so we are following really close on this case.
There was an interesting line from the FT talking a little bit more about Hong Kong's commercial property loans, and that has really hit the likes of HSBC. They're marking about 73% of its commercial real estate loans are as impaired or risky, which is quite a bit of a size up from just a year ago. What can you tell us on where things stand now on that front?
Yeah, I think this is aligned with what we have reported earlier and what we see in the market. So it's a very clear signal that the potential risk of those commercial real estate loans in Hong Kong overall is increased a lot. And I think the HSBC situation is mainly because of Hang Seng Bank is subsidiary. And we know that the non-performing loan for Hang Seng stood at 60.7%, the highest ever. So that's why we can see a lot of loans have been defaulted, and banks have been appointed receiver more to take over the underlying asset, and they are even willing to sell the underlying asset at a big loss. So those are real things happening right now in Hong Kong.
Trista, thank you so much. Trista Luo there, of course, our China credit reporter, on what's going on there. By the way, in the next hour of the China Show, we'll dig deeper into the other big stories here in Hong Kong, including this revival of the fundraising markets, which clearly hasn't affected what's taking place in the property market. Yeah, lots of new ones there. Plenty more ahead. There's a rally taking place as I speak across equity markets. This is the China Show.
Some stories that we're following for you today. China rapeseed futures jumped after Beijing said it's hitting Canadian imports with a 76% duty from August 14th after an anti-dumping ruling. It escalates a trade fight that's already seen Beijing slap 100% tariffs on canola oil. The Canola Council of Canada says the move will effectively close a Chinese market that was worth almost $3 billion last year. Bloomberg's been told that India and China could resume direct passenger flights as soon as next month in a move towards resetting political ties. Flights between key cities were suspended after the COVID pandemic, forcing travelers to transit through hubs such as Hong Kong or Singapore. Sources say a formal announcement could come at the Shanghai Cooperation Summit later on this month.
Right, just looking at markets right now, 24 minutes into the cash market session, Shanghai Composite ever so slowly has inched its way back, and we're here now at a 4-year high, and as you can see, it's reversed now virtually all of its losses from 2021, and right above, a little bit above the current level. We will be hitting, if it continues, of course, the current trajectory, hitting the highest level here, going back about 10 years or so, and it's also coincided with a pickup again in margin lending. Yeah, so the animal spirits are largely back, not completely. A couple of other things we're tracking here. Battery component stocks on the back again of some supply side push coming from the government there. We're up 9% on Anhui, Anfu battery technology, and other things taking place across these markets. The benchmarks, there we go. Hang Seng Index up 1%. There's a big rally taking place across tech, HS Tech on your screens as well. Top row, leftmost side. CSI 300 is also catching a strong bid. And yeah, yesterday this subsidy for loans boosting consumption, I think that came out towards the close yesterday, and possibly in the next hour.
There's a press briefing happening in just a few minutes from the likes of PBOC and Co. talking a little bit more about maybe this consumer loan subsidy plan. So maybe we'll hear a bit more at the top of the hour. Robin Xing from Morgan Stanley joins us too. Welcome back to the China Show. Here's a look at the HSI half hour into the session. More importantly, there is a typhoon that's coming, Typhoon 3, set to embark possibly on Thursday. But although it's blue skies right now, so enjoy it while it lasts, guys, right? But then again, markets don't care about that, right? We're still seeing pretty decent rally here in Hong Kong today, Dave.
Yep. Maybe similar dynamic, that's liquidity, which is the intersection between those two things.
Yeah.
1% to the upside on the Hang Seng Index. We're very close as well on some other benchmarks. So we'll talk about the Shanghai Composite in a moment here, but a quick glance at some of the other things. By the way, before I mention the other things, just to mention that in a couple of minutes, we are expecting a policy briefing coming through out of mainland China, maybe more details on some of the pronouncements over the last few 1 or 2 days or so. Right, very quickly. So on the trade tariffs and not everyone getting along front, the number one is Japan has started investigations into anti-dumping duties here from Chinese and Korean steel goods. That's why we have some of the steel makers on your screens, including, of course, POSCO. Separately, rapeseed meals up 4.3%. This is China imposing temporary tariffs on Canadian rapeseed after an investigation there. So we're looking at gains there.
Yeah,
4%. Canola oil.
We learn something every day. Yeah, the rest of the markets are doing this here right now. Japan's still extending those record gains that we saw, that we're seeing in Japan. So another day of that. There you go. Taipei is doing very well as well. Indonesia's coming online and doing okay. So there's this risk rally is definitely very broad-based across the region here today. Maybe it was the inflation print. Obviously, it maybe gave the green light, possibly a bit of breathing room for the Fed to really tackle more about, the weaker jobs data. Maybe they can, in fact, cut in September now. That seems to be the narrative right now, Dave.
Yeah, that's the EM tailwinds coming through in a weaker dollar as well, right? And I think Indonesia, case in point, had the best day in 4 months yesterday. Taiwan is very close now to an all-time high. And I think Korea is within about 5 or 6% from that similar superlative. But yes, as we were just pointing out, right, can we now breathe easy? And can we now just cement these expectations that the Fed will likely cut next month?
No, Scott Besson said even 50 basis points could happen in September.
If you consider the revisions.
If they actually had the revisions back then in June, July, they probably would have cut. That's what Scott Besson says. But then again, the market still seems to think maybe September is a sure bet. We're still talking about 2 more cuts possibly this year right now. But then again, there was still the whole side of tariff pass-through. You got to wonder, why was there a slowdown in actually the tariff pass-through this time around? Anna Wong from Bloomberg Economics says, look, maybe we saw a lot of that pass-through already in the previous months as well. Consumers are starting to push back against some of these tariff increases as well. So certainly maybe that might not be what we should focus on. But really, it is about services inflation that seems to be making a bit of a return. But they're still expecting, right, core PCE in July. That happens, I think, in a few days. That could be something that we need to really watch for. If it's a hotter print, that leaves a September rate cut far from assured, they're saying. Not quite a sure bet.
Not quite 100%. Yeah, which is a good reminder that there are a lot of potentially consequential data points coming up, right? So I think PC, to your point, end of the month. Retail sales.
Yeah.
We have a few weeks, of course, of initial jobless claims, GDP numbers, ISM, another crucial job support coming up as well. So yeah, nothing is certain. In life is certain, at least. There's your sort of advice for the day. Tencent Holdings, a stock we've been tracking. Earnings are coming out today. We're very close to, when I say very close, we're now within, let's call it a good year or so from maybe revisiting record highs as far as that is concerned. So right now we're looking at 2.4% to the upside. Highest level now going back 4 years after, June 2 of 2021 as far as Tencent goes, and we'll see what the earnings look like. And I think we do have this briefing.
Yeah. So this is quite a group of officials here. We're talking about the Ministry of Finance, the People's Bank of China, and other administrative agencies are briefing now. This is on the back of what we heard, right? There was this consumer loan subsidy for Beijing interest subsidy for consumer loans. So obviously that's something that could aid the banks for one thing, according to our economists as well. But certainly we'll see, right? You're starting to see more of this sort of consumption stimulus coming through, whether it's, childcare subsidies or the like. And so that certainly is one thing that a lot of economists are still looking into as maybe potential more meaningful stimulus on that front.
We had the perfect guest to, in fact, help us understand what this might mean for certain product categories. Morgan Stanley's Robin Xing will be joining us, of course, to talk us through not just this, but his broader take on the economy. While this is taking place, we'll get you more details on this in a moment. Something else also hitting a milestone as far as markets go, which is the Shanghai Composite has now virtually reversed all the losses from the 21 peaks. The top line is the price, bottom line is the drawdown, and as we get closer to zero on that basically tells you we are back to the highest levels in about 4 years. Beyond that is, of course, 2015 territory. We have a fantastic piece today on the terminal for our clients. It's also on the website as well, talking about how this quiet $11 trillion market has come back despite a lack of obvious major catalysts. You have mainland households, of course, coming in and turning to equities for better returns. You have low rates, low yields, helping push some parts of the equity market higher. Joining us to talk us through this is Abhishek Vishnu, of course, our senior equities reporter out of Singapore. Yeah, Abhishek, what is going on? What is the main crux here of today's piece?
Well, like I said, it's a liquidity-driven rally. Now, it has been a quiet resurgence, but it wasn't so quiet last year. We saw significant jump in markets. This year's gains, meanwhile, can be said quieter. And, the reason that our reporting, is showing is that liquidity is increasing, is improving on all counts. You talk about investor liquidity, allocations have started coming in from high-risk funds. And this is just a start, as they put it. Small caps have started rallying. We are also seeing significant improvement in other measures of investor liquidity. And while the story doesn't talk about it, but if you look at M1, M2, a broader system liquidity as well, which correlates nicely with any kind of risk asset, that has also done pretty well over the last 3 to 4 months. So all in all, this is feeding into equity markets, and there is a huge amount of household savings which are beginning to get channelized into the stock market. So, the outlook is of more upside. But at the same time, the earnings outlook, the economic outlook still remains, sort of a to be sure kind of point, which checks this story. The optimism definitely remains on expanding valuations for China because they remain cheap. If earnings also come through, which we'll see today, from the likes of Tencent and maybe JD.com, by the end of this week, then this story would get more credence.
Yeah, and what is the take from the analysts that you talk to, right? Does it need an earnings recovery, economic, fundamentals to improve to really keep this rally going, or can it still rally on just liquidity alone?
See, liquidity would drive any market over the medium term. Earnings are required for the long term. Now, cycles have shortened, but long term would still be 3 years. Medium term would still be a year to 2 years. So, the rally can keep going for a few more quarters. But Earnings returns, as a lot of empirical studies have shown in past, equates to how stock markets should be, generating returns, what kind of returns stock market should be generating. So they still remain of great importance. But having said that, look, China is not alone in this rally. I mean, you guys were just talking about Taiwan, Indonesia, US has hit a record high. So, a cheap major market tied to a very major economy pivoting to domestic consumption and doing efforts to revive its economy is definitely going to play catch up. So the setup looks really good, whether you compare it with the world or just China's internal fundamentals.
All right, Abhishek, thank you. Abhishek Vishnoi there, our senior Asia equities reporter, joining us out of Singapore. Take you back to those live pictures out of Beijing here this morning with the likes of the MOF, the PBOC, and other administrative agencies briefing the media on the interest subsidy plan to cut financing costs for service sector firms and boost domestic consumption. So that's what we're hearing so far. But we are actually seeing some market reaction, right? Some of these retailers are actually benefiting from it today.
Yeah, department store shares is one group that we're seeing almost limit up in some cases. They're also seeing some healthcare stocks really benefiting from this. Just effectively think, if you take a personal loan out, where would you take that money and where would you use that money? So the benefit, it seems, and just looking at the headlines here, we'll get more details on this, is really a government subsidy on the interest payment if the consumer loan is eligible to come under that. So again, this, not so much to bring up anti-involution, right, but it's a subsidy really to bring down the cost of consuming. And in this case, of course, slight personal leverage to be able to afford, of course, personal goods and daily things.
Set to take effect September of this year, so it's coming up soon.
Yeah.
They're talking about the subsidy applies to loans under 50,000 renminbi for consumption, as well as designated big-ticket items as well that are over 50 grand. So that includes the likes of autos, education, healthcare as well. So that's what we're hearing. And it is involving a lot of these major state-owned banks, some commercial banks, and also some licensed consumer finance institutions, including like the WeBank and Ant Group are the approved lenders. So yeah, we're hearing a little bit more about this plan so far.
Yeah, and does that lead to more personal loans getting taken out? And is that a boon for business on the banking side, which is the other sector I guess we need to be talking about as well? Anyway, we will leave this here for now. More details coming, and of course coming up as well to help us understand maybe what this might mean for the path of the consumer coming back. Morgan Stanley's Robin Xing will be joining us in a couple of minutes to help us understand where we are on the economic recovery.
All right, we're watching the retail sector, the consumer healthcare space in particular that are rallying here this morning on the back of this government announcement, a plan to subsidize interest payments on eligible personal consumer loans. So you see the likes of Hebei department store, for example, it's up some 10% here right now. Now, the subsidy, what we're learning about it is that it applies to loans under 50,000 yuan for consumption, as well as for big ticket items such as autos, education, and healthcare. We'll see what this all means. Morgan Stanley, perfect timing, is here. They see this as a potentially beneficial to Chinese consumer healthcare stocks in particular. Robin Xing, their chief China economist at Morgan Stanley, is here to react to this. How big of a stimulus do you think this could be?
Well, if you take a step back, connecting the dots, this is a part of their journey to gradually tilt towards consumption. So you heard so much about anti-involution in last 2 months, but we know to do this anti-involution just based on supply cleanup is not enough. You have to boost the demand. And so far we have seen so many small steps, but the right direction. The fertility support, about 100 billion yuan. The free preschool education, another 30 billion yuan. And the most recent one, today's announcement of the subsidy on consumer loan. So connecting the dots, they are gradually shifting towards consumption. That's definitely positive for the macro narrative.
I can't help but think when someone mentions personal loans, right, it's almost up to the consumer what to do with that money. And, I think part of what they mentioned here, big ticket items, autos are part of that. You could also take a personal loan out and put it in the stock market, right? If you think about it, it's almost subsidizing the cost of putting your money in the stock market. What do you make of what consumer behavior is right now? What are people doing with their money in China, which to some extent has gone into the equity market. What does that tell you about consumer behavior?
Yes, David, you mentioned a very new but very important factor. Liquidity is in driver's seat. Talking about consumers, they put so much money in the term deposit in the last 3-4 years. But right now, China's long-term rates are very low. Liquidity is quite abundant. We see some early signs, be it institutions like lifers, asset managers, or consumers. They are gradually shifting away from bond or term deposits into equity-linked exposure. So this is still early, but it's real. However, this is more about liquidity-driven grind higher for the equity market. In the Chinese investors' dictionary, they call it water buffalo. So slightly different from conventional fundamental-driven bull market. The fundamental-wise reality check is not great. Deflation is here to stay, and the data will be soft in the second half. We had too much front-loading of exports, of fiscal impulse in the first half. So second half, we will see paybacks. That's why I think it's very important to see, can they combine the supply side cleanup, anti-involution, with demand stimulus. And these small steps, they are small, but moving in the right direction. So I think, Yvonne and David, you have had me here maybe 3 or 4 times since late last year. First September period, 2024.
It's almost 12 months.
They started to tackle the deflation directly. Then January, February this year, the so-called comeback of animal spirit. Jack Ma is back, this deep-seek movement. Then this summer, anti-involution. I think every round, if you are cynical, you can say these are not a game changer. These are only baby steps undershooting. But every round, it helps the narrative on China keeps evolving, keeps improving. So connecting the dots, I think, is definitely positive.
I want to get your take on, you still think, though, despite what we're hearing on anti-involution, that your base case of persistent deflation is going to here to stay into 2026. Why? What are you seeing? I mean, we're seeing prices come up in the upstream side of things. Where else? How does this all play out in terms of inflation, or lack of thereof?
Anti-involution means try to put an end to destructive competition. So the aims are clear: stopping these subsidy races, try to allocate more efficiently, and try to gradually tilt towards consumption. But this is not 2016. In 2016, supply-side reform achieved a big success because it was only in upstream sector. Overcapacity was only in steel, coal, a few upstream state-owned sectors. Today's pressure sits in downstream sector, private, new economy sector. So it's much more complex. You can't do a mandate of cutting capacity. You have to do it in a measured, market-first move. And that means you have to be patient. And right now, there are a lot of rhetorics. But the rhetorics turns into rules, at least several months lag. So we have to be patient. I'm not changing our PPI or CPI forecast for the rest of this year. But within 12 months, if they can use the fourth plenum in late October this year to address some of these fundamental problems, like try to set up a unified national market, shifting the tax system towards one that rewards efficiency and income, and change the local government incentives from rewarding output to rewarding household well-being. If they use 5-year plan in the fourth plenum to address these issues, I think finally these pieces fall into place. This story will upgrade from a so-called water buffalo into a fundamental-driven reflation.
The issue, as you point out, is markets can be impatient every now and then. You know, markets tend to move quicker than the economy, and in this specific case, likely going to move quicker than the inflation print comes out. So you have a fantastic diagram here. I wish I could show this to viewers here of just help us understand what the base case reflation path looks like. What is a durable exit from deflation here, and when do we get to that point?
3 signs. First is price indicators broadening firm, not just the upstream PPI. Upstream is easier. You can do consolidation among SOEs. But it's about the downstream PPI and the core services CPI. So that's number 1. Number 2 is corporate profits and wages inching up. So people start to find the good jobs because firms start to hire. Last but not least, consumption as percentage of GDP going up because social safety net is being deepened, covering more and more migrant workers and farmers, so people feel safer to spend. That's the three signs to judge if this is a success for China's anti-evolution.
Okay, so that's the path to reflation. What's the path to tariffs? I mean, we're starting to get more of these trade deals between the U.S. and North Asia and maybe parts of the region here. We're still waiting for some sort of trade deal with China, but it seems like we're seeing lower tariffs for the rest of the world versus China. Is China going to end up in a weaker position in all of this?
Well, I do agree with you. Uncertainty is here to stay, and this extension of the U.S.-China truce is a pause, not a peace. So if you look at the global endpoint tariffs, they are drifting up, and the tariff on China, as you said, is higher than most other trading partners. This means in the first half of the year, you got too much front-loaded exports. But the keywords for the second half will be paybacks, not mentioning this tariff uncertainty will probably weigh on global capex. So China's exports is going to flatten, and that external tailwind is going to convert into headwind in the second half for economic activities. But will U.S. and China go back to that prohibitive embargo level of escalation back in April? That's very unlikely. The U.S. reliance on Chinese supply chain is real, and Beijing has been playing the real earth card. Yeah. So I think, yes, there could be some bumps, but a complete breakdown is unlikely.
One view that's emerged this week was, Chinese exports will find their way into a market. I'll use your analogy on water. Water will find its way, right? And I wonder what your view is on, fine, there might be payback on the U.S. front, but at some point, those exports are going to find another market for them.
Because they're still cheaper.
Because they're still cheaper and better.
Yeah.
Yeah, I saw a great chart from you guys on, the Chinese exports to different regions. To the U.S. is down, to ASEAN, and a lot of other regions went up, showing the evidence of transshipment, right? Yeah. So it's up to corporates how they navigate these tariff and uncertainties with their own resilience and diversification of supply chain. But for Chinese jobs, for Chinese output, if you have transshipment, it's still bad for the Chinese own jobs and the output, right? Because that basically means you have to at least allocate a bit more of your process of manufacturing in other countries to avoid further tariffs. So I think China needs to focus on domestic consumption, and all these anti-evolution need to be combined with clean up in the supply side plus demand stimulus. That's the only way to address all this global uncertainty on tariffs.
Yeah, fix your house, right?
Yep.
Robin, thank you so much. Fantastic. Robin Xing, Chief China Economist at Morgan Stanley. On Robin's point, there, of course, is ongoing briefing in Beijing on the more measures to boost consumption. Just to mention also the Taiwan stock market separately has hit the highest level pretty much on records. We were within 1% at the open. We're basically there as we speak.
Well, we're seeing Australia at record highs, Japan's in record highs.
There.
Taipei joining the fray there. For more on this, of course, ongoing briefing in Beijing, for Bloomberg subscribers, you can keep watching it on Live Go. You'll also find the big diary entries coming up today and later on this week, as well as some of the events you may have missed earlier. We got plenty more ahead. This is Bloomberg. All right, Taylor, when it comes to the market check, it is a good day to be long on equities here right now. We are seeing records being hit potentially in Taipei. Japan's looking pretty good. Australia right now, we're 0.8% to the upside on MXAP here right now. And yeah, Indonesia had a really good few sessions as well. We're up 0.9% in Jakarta here right now. A lot of it has to do with maybe the inflation print and the U.S. and how it was pretty market friendly there. So basically, stocks were a buy, dollar was down. So that really is helping the EM complex here today. And we still got earnings out of China kind of tell you about. Tencent, there you go. We're up 2.4% here ahead of those results coming through. And HS Tech is doing very well today.
Yeah, lots of stars are aligning, including this latest one coming through out of Beijing. The more support and subsidies for personal loans. More on that in a moment. The market's doing well this Wednesday. This is Bloomberg. Right, welcome back. We're going into the Japanese lunch break where the Nikkei, if you're wondering, when was the last time you saw the Nikkei at 43.30? And a moment in time comes back to your head. You're imagining it because the Nikkei has never been at this level. 43.3 on the Nikkei 225, 1.4% to the upside. Has been a stellar week. It was shut Monday, reopened yesterday. Fireworks all about, and of course, further gains today. The tailwinds coming through out of the U.S., weaker than expected CPI on most things, not core CPI, maybe providing the tailwinds here. It's not just Japan that's doing well, the rest of the region. And separately, China's doing well, maybe on the back of point number one we just made, but also some of the idiosyncratic domestic policy pronouncements that we're just hearing from as we speak. All things equal, MSCI Asia Pacific is now at 212, which means we're about 5 or 6% from reaching all-time highs on that. We're focusing on Hong Kong now, and here's a recap of some of the recent stories and headlines coming through here as it pertains to Hong Kong. You might have seen this, the FT reporting almost 73% of HSBC's Hong Kong commercial property loans have been flagged as risky. Now, developers including New World have been in focus of much of the stress here in the local real estate market. Hong Kong's rents, office rents specifically, have fallen over 20% since 2022, and vacancy rates are at record highs. Meanwhile, the city's rental housing market is expected to hit record highs by October, fueled by this influx of mainland Chinese students, and we'll get to this other bit in a moment, professionals. According to online property listing for platform Spacious, rents in July were up more than 1% from the previous month. Rents are now just 2.2% below their 2019 peak.
Yeah, and you gotta wonder, right? Rents are high, but maybe because people are not buying. This is still a property market that is still on the weaker side. And that's despite the fact that we're seeing equity markets are roaring. The IPO market in Hong Kong is certainly coming back to life as well. Where is that wealth effect? That certainly is one of the key questions we're watching out in the big take here today. But we're focusing a little bit more on the IPO market, right? And really why it's been roaring. Thanks to a growing number of companies raising billions of dollars. And as you can see from this chart, it has mostly been driven by mainland Chinese firms that are raising money here in the city, right? So whether it's in an IPO, we talk about different types of commercial bonds and the like that they've been issuing as well. But you take a look at it, right? And you stack up how Hong Kong Exchange has done since the start of this year amid this listing boom. And it is by far one of the best Hong Kong exchanges in the world, if you compare it to likes of Euronext, Brazil, TMX, the like here. So certainly there's a lot of questions about this, right? And then again, the narrative seems to be changing a lot. Not just the makeup of some of these companies, but really kind of the narrative about Hong Kong itself. Before it was seen as a global financial hub, and maybe, the world's sort of bridge into China. Now things have shifted a little bit, right? Now it seems like it is this sort of capital-raising platform for Chinese companies that want to develop and expand abroad, Dave.
Yeah, in fact, let me read one line from this fantastic piece that's come out. It's risking the backlash from Washington politicians. This is a really good line, who are increasingly questioning where Hong Kong ends and China begins. This is the big take today, certainly the subject of a very interesting, comprehensive topic. Let's bring in our Asia Equity Capital Markets reporter, part of the team that came up with this fantastic piece today. Julia Fioretti is here with us on set to talk us through. Let's start with the basics. What's been behind? We know about this deal surge. What's been behind it?
So there are a number of reasons, and the overriding reason is largely that China has opened the sort of the regulatory sort of not floodgates, but they've sort of allowed offshore listings again, and they're really encouraging them in Hong Kong. And that, coupled with obviously the 24% rise in the Hang Seng index, increased investor optimism over China. That was partly started by DeepSeek back in January, and a sort of a resurgence of confidence in the Chinese economy despite the ongoing challenges, and that's really helped Chinese companies come to Hong Kong and tap the market here and raise funds. And so that's why we've seen this resurgence of deal activity this year, which also started late last year.
How do you see this different than what's happened back in 2021, for example?
Well, back in 2021, it was pretty different. It was, firstly, it was a global deals bonanza in a way that interest rates were basically at zero because of the pandemic back then. So there was just a lot of free money in the system, and that kind of helped drive listing activity globally, and that's still a record year, obviously. Whereas this time it's different. Obviously, interest rates are not at zero. It's less of a global phenomenon and more sort of a one driven by China. The types of companies that we're seeing are also very different. That was proper IPOs by private companies, often big, large tech firms, and that's sort of not really what we've been seeing now. It's mostly so-called A-share to H-share listings by companies which are already listed on the mainland exchanges.
The entire ecosystem seems like it's operating at, capacity, right? And I think one graphic here on the piece here is, bankers are back. The number of licenses have been trending higher. We're going to show the graphic in a moment. Bankers, lawyers, you guys covering this part are extremely busy as well. Just give us some context. How busy are things, relatively speaking, these days?
It definitely feels as busy, or the busiest since 2021, in terms of how busy the bankers are, what the kinds of deals, the number of deals, the volumes that we're seeing. There is also some selective hiring across the street. It's still not quite at the levels we saw back in 2021. It's still mostly focused on more junior roles, but I think in the piece we have Kirkland is selectively hiring and others as well. So there's definitely, obviously, after all the layoffs in the recent years because of the slump in deals, the banks have come into this year with a smaller workforce, obviously, and now that the deal activity has really ramped up, they're looking to hire to sort of be able to cope with this workload, although it's still, as I said, rather selective.
There's also the geopolitics involved as well. But you bring it back to CATL, when JP Morgan and JP Diamond were questioned by U.S. lawmakers on their involvement in that listing. Tell us a bit more about the risks to U.S. banks.
Well, that deal is quite emblematic in a way of the risks. So Bank of America and JP Morgan were questioned. They were pressured to drop off the deal, which they didn't do in the end. Jamie Dimon publicly defended their decision to work on it. But it certainly shows that there is a lot of political pressure, that Hong Kong is still at the fault line between China and the US, and the tensions, whilst they sort of ebb and flow depending on the relations between the leaders, there is still some tension back bubbling. Obviously, there's economic competition, whether it's for AI and semiconductors, and so that we're seeing that as well. And so whilst the global banks are doing well in this deal boom, they do still face potential pressure from Washington, and that's not really going to go away anytime soon.
Fantastic piece. You can check that out. And a big takeover for our Bloomberg clients. Julia Fioretti there, Asia Equity Capital Markets reporter. Just to mention as well, without going into details here, we have a very big interview coming up in 2 weeks' time. So stay tuned for that. I will leave that and just plant that seed on this very topic.
Suspense, Dave. Yeah. All right, yeah, it's coming up. It's a big one.
It's a big one.
I can tell you that.
Okay.
All right, we've got another big interview coming up as well. Trade, of course, is the center of the U.S.-China rivalry that's putting Hong Kong's deal-making boom at risk. And speaking of trade tensions, the White House senior counselor for trade and manufacturing says companies outside the U.S. will end up paying most for President Trump's tariffs. Peter Navarro told Bloomberg he doesn't trust the latest Goldman Sachs research that says Americans will end up bearing about 2/3 of the cost.
They're saying, well, it's either the consumers are going to eat it with inflation, or the producers are going to eat it. Mm-hmm. But the third possibility is the one which actually historically shows is the case. The reason why we're not seeing inflation because of the tariffs is because it's the foreign countries that are eating the tariffs. Why do they do that? Foreign countries, the big ones we run the big trade deficits with, we are their biggest market. Okay, if they can't sell to us, they're in trouble.
Do they pay it by giving it to their companies, or how do they?
Their companies have to eat it.
Where's the check?
The companies earn less profits at the expense of we win, they lose.
You saw the Goldman research on that, right? It got the president pretty upset today. Goldman found according to its research, that consumers in the U.S. have absorbed about 22% of tariff costs, businesses 64%. You're saying that's just not true.
The only entity which has less respect in terms of their data than the BLS these days is Goldman Sachs. I mean, think about it, Joe. It's like the advantage I have is I was here during the first term of Donald Trump. And everybody was saying that we were going to have this wild, out-of-control inflation. The Wall Street Journal personally, twice in lead editorial, said there was going to be a Navarro recession because of tariffs. This never happened, and Goldman Sachs was one of the big voices that was always doing the panicking inflation kind of thing. I just don't trust their numbers. And the reason why the American public shouldn't trust their numbers is because their numbers are usually wrong. And yeah, I had to fight, interestingly enough, in the first term. The first guy who was the National Economic Council director was Gary Cohn. He was a Goldman Sachs guy, right? He's the guy, Hassett does the job now beautifully. But I had to fight Cohn every day when he was there because he kept saying, Mr. President, these tariffs are bad. They're going to cost consumers. They're going to slow everything down. They never did, and Cohn left with his tail between the legs because he was always wrong. But the point, Joe, is trust your eyes. Trust your eyes.
And that was Peter Navarro, White House Senior Counselor for Trade and Manufacturing, with, of course, our colleague Joe Matthew there in the United States. Right, really on this topic, right? So President Trump's tariff policy was meant, at least on some level, to rebalance global power in America's favor. The reason I frame it that way is certainly he's getting a lot more wins in terms of being able to bring in some of the money there. But certainly the bigger picture on trade here, our Bloomberg Opinion columnist, Karishma Vaswani, actually thinks that China is enduring all this short-term economic pain to eventually shape any deal or any trade deal to its eventual advantage. Karishma, in fact, joins us right now. Karishma, good morning. Thanks for joining us. China's winning the long game, as you say. Why do you think that's the case?
Well, David, I think, as we've talked about before on your program, the fact that China has been able to go through these various rounds of trade negotiations with the United States without giving up much in terms of actual concessions. You know, there have been sort of small compromises made, but very far away from American demands. And what's resulted from the outcome of these negotiations is just a commitment to simply talk again. And what that does, David, is it gives more time to the Chinese Communist Party to go ahead and make plans for what it's going to do with the slowing economy, as you talked about, of course. It is a very precarious trade position in China. The economic picture is pretty bleak, but it does allow the Chinese, and in particular President Xi Jinping, to lay out a plan for the country and to figure out how to become more self-reliant in the face of these higher tariffs that the U.S. has threatened to impose on China.
Okay, you mentioned that the self-reliance sort of theme. So tell us a bit more about that and how this delay will actually help China.
Well, you know, the Chinese have been on this path of self-reliance for some time, as you well know, Yvonne. And one of the interesting things in the research that I did for this column was looking through the details of a RAND, that's a think tank, a RAND research report that looked at the areas where China is pushing ahead in terms of this self-reliance. Now, obviously, in order to do that, it does need access to a degree of high-end American technology. But what this research report and many people that I've talked to have said to me is that the innovative push within China, particularly in the tech sector, has been accelerated as a result of the pressure that it's getting from the United States. So ironically, the more time that Xi Jinping has in terms of the delaying of any concrete trade negotiation, the more time he gets to be able to accelerate that push of self-reliance. And it's a very compelling argument to citizens at home. The narrative that's quite well worn by now in terms of the fact that the U.S. and the West is trying to keep China down. And it's this idea that the country has to rally together. It has to endure this bitterness and pain in the short term to get long-term results.
Yeah, so Karishma, if time is on your side, and I think you've also alluded to this as well, that when you look at state-run commentary, this, the philosophy of a protracted war, for example, that I think was in some ways evident, for example, during the Mao era, to help get through this trade war. What does that mean in today's context?
Yeah, well, I found this really interesting. This kind of language started creeping up a few months ago in commentary from state-run media, I should say. And what it's alluding to is this essay that emerged during the Mao era called A Protracted War, when it was espousing the fact that the Chinese would have to fight and sort of hold their ground against a much more powerful and stronger competitor. And this kind of language is now being used to describe the strategy that China should use with regards to the trade war. And you hear this time and time again, David, and what I think it shows, or what I think it displays about the Chinese resolve to withstand the impact of this trade war is they're in it for the long haul, right? They are willing to take on the pain of what happens to the economy in the short term, because they have sort of propagated this idea that being in this and enduring it together is what's going to get them victory in the end. And that is a victory they're willing to wait for.
Well, patience is a virtue, as they say, right? Karishma, thank you so much. Karishma Vaswani, our Bloomberg Opinion columnist there. You can read, by the way, on a Bloomberg terminal for our clients here. Karishma's column, among many other things. If you want the audio-visual version, there's one on TV Go. Of course, you can scroll back and catch the glimpses, of course, of the highlights from this conversation we just had there with Karishma. Other functions you can be that we bring up here in shows. And yeah, obviously, if you want to be part of the conversation, do send us instant messages as well. You know how to reach us. TV Go. This is Bloomberg.
Well, hundreds of residents poured onto streets in Jiangyou, now in the southwestern province of Sichuan in China last week, and clashing with police officers. And the protest was sparked by anger over police handling of a case of a schoolgirl attack that was circulating on social media. Let's bring in our China correspondent, Min Lo, to bring us up to speed about this story.
Yeah, so it started on August 2nd when this video started circulating online, and it showed this schoolgirl, 14-year-old girl, who was being attacked by multiple other girls. It was extremely brutal. She was kneeling on the floor and they were kicking her repeatedly from the back, from the front. They were slapping her, verbally abusing. And it's so hard to watch. I actually couldn't bring myself to finish that video, but it's a very painful video, and it sparked a lot of outrage online. People were concerned about how authorities would respond, and it took over a day for the Public Security Bureau to respond, and they said that the victims' injuries were mild. Two of the attackers were being asked to undergo corrective education, and I think people were up in arms about the characterization of the victims' injuries, because it was very clearly not mild. Here you can see the social media footage of the clashes with police, because soon, hours after that official statement came out, people started surrounding the local government building, and it just gathered momentum. And by the evening, there were hundreds of people there. The police were out with the batons and were, manhandling some of the protesters and taking at least a few away, according to the videos that we have seen.
Yes. It's rare to see this, right? A sort of protest in China. It brings me back to what we saw during the COVID-0 lockdowns, also when it came to that during the housing crisis and the like there. But certainly, can you tell us a little bit more about whether this is an isolated incident or not?
Yeah, as you said, we do see protests quite often in China, but usually it's tied to economic events.
Yes.
It would be, property disputes or employment disputes. So it's actually quite rare to see protests related to social justice. In this case, it was revealed that the mother was deaf, so it really heightens that sense of inequality. And it's not isolated in the sense that in the last couple of months, there have been a few big incidents. There was a lead poisoning case in a kindergarten in Gansu province, and then there was this case in Hangzhou where there were brown brown liquid coming out of bathwater taps, and it took a while for the state-owned water company to respond. And in both of these cases, not that there were protests, but there were a lot of discontent online. And in all these cases, the local authorities would put out a statement to refute some of these public concerns. And analysts say that this approach has not been working, right? Because it seems like for China, it's so important to maintain social stability that the first instinct for local officials is to cover up these things in order to not risk their political careers. And it's interesting, if you watch the video, you can hear that some of these protesters, they were singing the national anthem in a way to perhaps show that the target of their anger is not the central government, it's the local officials, or you can interpret it as a way to protect themselves, maybe to cast themselves as patriots here rather than the provocateurs.
Min, thank you so much there. Min Lo with the details here on this quite a rare occurrence, of course, taking place. Our China correspondent there. Very quickly, before we just head to break, a brief look at markets. Hang Seng Index, what do you think that is good? Generally speaking, on price today, yes, because you're getting a rally across the big tech names. This slow grind higher on the mainland benchmark, Shanghai Comp, 4-year high, CSI 300, 11-month high. Shenzhen Comp is now at the highest level, going back 3 years as well. So this resurgence of the onshore markets, more on that in a moment. This is Bloomberg. Yeah, interesting, in case you saw that promo, either a moose or a water buffalo. Anyway, quite literally, water buffalo is how Morgan Stanley's Robin Chang talked about this. What's been taking place in the onshore market, where you have a lot of liquidity, that's the connection there. Yes. Money being taken out of time deposits, low interest bearing securities into the stock market.
Yeah, and that's what's really kind of keeping this rally going. But is it enough, right? As you mentioned, is it enough to just have valuation and liquidity when you don't have the earnings momentum, when you don't have the economic fundamentals, right? And Bank of America, they just had a pretty interesting note about this as well. The stark divergence that you're seeing between the weak economic fundamentals and improving stock market performance is drawing some attention among some of the domestic investors that they talked to as well. I think they had 12 client meetings of late, and that was one of the common themes, was this disconnect. And really, they also mentioned it comes down to liquidity, but there's still a lot of lingering concerns, right? Whether it's the potential tariffs related to Russian oil purchases, the re-escalating of trade tensions, that there are still some things that they have to really worry about is the second half macro outlook. Yeah, which I think Morgan Stanley still thinks a slowdown is likely going to happen in the Chinese economy, and of course that pushes back even further any catalyst for inflation to come back, and then demand, and then that takes us into the earnings story. And I think what he said too is any sustainable exit from deflation will take time. And, if you are to trust that trend, it will take time for us to get there. And it can't just be supply-side reforms where you're cutting output. Yeah. It has to be coincided with some sort of demand-driven stimulus, right? So we mentioned about some of the subsidies that we're getting in terms of, loans that we just heard from officials here today. That is part of that demand sort of consumption sort of stimulus that we're sort of seeing, in different facets of it, right? If we can see more of that, he says maybe we could see more of this whole anti-involution theme play out as well. We're taking Thailand markets coming out. We have a Bank of Thailand decision too. Definitely one to watch as well. That is it for us here in the China Show. Insight with Helen Amen is next.